Hello, I'm David Frazier, the President and Chief Market Strategist for Frazier Mayer Research LLC and for our individual investor service, Frazier's Strategic Allocator. We're recording this week's internet TV show on Thursday, December 22nd at around 12:30 in the afternoon. First, before I forget about it, I truly, very sincerely wish all of you a very, very happy holiday season, you and your family, I should say. And for those of you that are Christian, a Merry Christmas. If you're Jewish, a Happy Hanukkah. And whatever religion you are, I mean, it doesn't matter to me what religion you follow. I wish you a happy holiday season. Having said that, I'm going to keep this week's video rather short, and the reason is primarily because I'm currently focusing on our regular monthly investment journal, which I plan to issue hopefully on Monday of next week. That's when it's scheduled for, but at least early next week. And as I do always in those monthly publications, I'll discuss numerous fundamental economic factors from around the globe, as well as the recent trading action in the U.S. stock market, and of course our recommended holdings, securities that we've recommended purchasing fairly recently. And let's take a look today as I had at the overall market. As I had expected, stock prices in general, at least U.S. stock prices in general, as measured by the major stock market indices, have moved pretty much in a narrow sideways pattern this week, and that's what I was expecting. And I think there's probably about a 50-50 chance actually that we'll see a modest pullback, I think, next week and maybe over the next couple weeks. And then again, stocks might just start to move higher once again after trading sideways this week. I mean, I think we're going to see some rotation, as I had discussed a couple of weeks ago, out of stocks that were some big upward movers right after Donald Trump was elected as the 45th U.S. president. I think we're going to see, and I think we're already seeing actually, some rotation, not substantial, but some rotation out of those stocks, primarily commercial bank stocks and infrastructure stocks, into other sectors and industries of the market. But regardless of any such rotation, I think we're going to see bank stocks and infrastructure stocks stay near their current levels. And I'm not going to, as I've mentioned in the past, I don't want to chase after any of these stocks. I think commercial bank stocks are going to do very, very well during the year ahead. But they've, as I think most of you probably know, they had some substantial moves over the past couple of weeks and over the past month, really ever since Trump was elected. And we don't want to chase after these and get in at an unnecessarily high price. So we'll be patient. Let's see, let me review briefly our current recommended holdings. As hopefully you've been checking your email every day, hopefully, and you've noticed that I've issued several trade alerts over the past few days and over the past couple of weeks. And so instead of me mumbling here, let me get right into these. First, I'm going to take a look at our growth and income portfolio recommendations. I'm looking at a screen, a stock monitoring screen, in case you're wondering. And I'm showing, if you're following my recommendations, you should be 65, those of you that follow our growth and income portfolio we now have a 65% allocation to equity securities, stocks, ETFs, and ETNs, and 35% allocation to cash. For income, we have a 10% allocation to the JP Morgan. Just a moment, please. I want to pull something up here. Looks like I left something off there. Figures. Well, let's see. We have a 10% allocation to the JP Morgan Alerian MLP Index ETN, and that's moved up nicely over the past few days. So that's always positive. We'd rather see something move higher after we recommend buying it, or actually do buy it for ourselves, than it moving sideways or lower. And also a 10% recommended allocation to the UBS eTrax Alerian MLP Infrastructure ETF, and that also moved higher over the past few days. Let's see, another recommendation is the Nuveen S&P 500 Buy Right Income Fund, which pays a very sizable annual dividend. We have that's moved sideways over the past few days. Tends to move sideways. Never really any big down movements or big up movements in the security, unless we see stock prices in general rise substantially in a short period of time, or fall substantially in a short period of time. And that, along with the fact that this buy right, this covered call writing ETF, pays a big annualized dividend. I think it's around almost almost a little over 7%. Now this is why this is in this portfolio. This is a growth and income portfolio. So let's see, the Gabelli Equity Income Trust preferred stock, Series H, moved lower over the past couple weeks. It's currently trading at around 12:30 in the afternoon of December 22nd, around $22.50, and so that doesn't surprise me. I mean, we're going to have interest rates increases during the year ahead, and some of you might be thinking, well, why do you have me into security if we're going to have interest rate increases? Because this security does have some interest rate risk, and the reason being is quite simple. It pays a very reliable annualized dividend of around 5%, and I don't see any substantial price risk. We've had a pullback in the past few weeks. Doesn't surprise me, but I just don't see any substantial price risk in this. And in my opinion, anything that we might potentially lose in regards of price depreciation will make up for in more growth-oriented type securities for this portfolio, such as the Granite Construction Company, GVA infrastructure stock, as well as I think in the iShares Dow Jones U.S. Medical Devices ETF, and the Cliffs Natural Resources. Let's see what else, and also Vulcan Materials. Those securities, that is Cliffs Natural Resources, Vulcan Materials, and Granite Construction. I recommended these not for income, but for growth. And just looking at how these stocks have performed since I recommended them, I think we got into some really good price levels in these securities. So I feel very good about all of those holdings for our growth and income portfolio. And of course, I'll have more to say about that portfolio and its recommended holdings in our monthly investment journal. Moving on to our fixed income portfolio. I want to pull this up on my screen, so if you'll bear with me for just a moment. We now, those of you that have followed those recommendations, we have a 75% allocation, recommended allocation to equity securities, and only a 25% allocation to cash. Some of the same holdings that we have in our growth and income portfolio, such as was specifically the JP Morgan Alerium MLP Index ETN, as well as the UBS E-Trax Alerium MLP Infrastructure ETN, and the Nuveen S&P 500 Buy Right Income Fund. And but in addition to that, we also have in that portfolio the Welltower, which is a healthcare REIT, and the Vanguard REIT ETF, symbols V and Q. And except for Vanguard, all of these securities pay some really sizable annualized dividends. I mean, AMJ at 7.4% as of today, MLPI 6.5%, BXMX, that covered call ETF, 7.2%. Gabelity Equity Trust Series H preferred stock, right now today 5.5% annualized dividend. Welltower 5.3% annualized dividend, and the Vanguard REIT ETF earning a 3% annualized dividend. But I expect any price depreciation that we have seen over the past few weeks in the Gabelity Equity Trust preferred stock, which I think it's probably going to hold right around $22 a share. I expect to make up for in this Vanguard REIT ETF, which, even though it pays a much lower dividend, I think we're going to get some good price appreciation out of that. Excuse me, please. Moving on to our speculative portfolio recommendations. I pulled up the wrong thing. Just a moment, please. You know, I've made some what some of you might think are some bold moves, but this is a speculative portfolio, and it's I think bold moves are justified for this type of portfolio. And for example, I've recommended essentially, my thinking is, well, if why not just be very, very direct? If my research indicates that infrastructure spending is going to rise considerably during the year ahead under Trump and over the next few years, well, if that's the case, well, obviously, if that does in fact happen, and I think it's extremely good chance it's going to happen, well, of course, there's going to be a big demand. The demand for steel is going to increase relative to supply, in my opinion. The demand for palladium, the demand for oil, and petroleum products in general, as well as the demand for copper. And that's primarily why I recommended these securities. I wanted to get in at reasonable price levels, and that's why I was waiting for the pullbacks, and we saw some pullbacks on light trading volume. In all these securities, those pullbacks, they held near some key price support levels, and the price momentum statistics indicated that they had fallen to oversold levels. Of course, I wrote that in my trade alerts, and I feel good about these securities. They're speculative, but I think we got in at a good risk-reward price levels for all those securities. Well, I guess I didn't mention securities. I'm speaking, of copper, of steel, palladium, and I think the securities I'm speaking of. For copper, it's the IPATCH Dow Jones UBS Copper Total Return Sub-Index ETN. For palladium, it's the ETFS Physical Palladium Shares, symbols PALL. And for steel, my recommendation was to get into an ETF that holds several steel producers. The VanEck Vectors Steel ETF, symbol SLX. And I feel good about where we got in these securities. Anyway, enough said about that. I feel good now. We never know what's going to happen tomorrow or the next day. But I was monitoring the securities carefully, and based on my experience and research, I think we got in some good prices. And the same is the case for the ProShares Ultra Dow Jones Crude Oil security. I think we got into a good price level with that. That's at ETN, by the way, Exchange Traded Note. Let's see. Let's move on and take a look at Restoration Hardware. I mean, it's the same thing about all these securities. I'm just looking at them on the screen right at this moment. Tesla Motors moved up over the past approximately 3 weeks, currently trading a little over $208 a share. I have no, that's a recommended short position. I have no concerns about that. In fact, if it were, looks like it's, if you don't yet hold a short position in that, this is probably a good time to sell Tesla short. Looks like it's running into some price resistance levels and overbought territory. So I'm just reviewing securities that we currently hold, and let me say this now. Unlike a lot of these financial newsletters, financial market newsletters, I tend not to make a new recommendation every few weeks. A lot of these financial newsletter services that I think I know their thinking is that to keep the subscribers interested, you supposedly need to make a new recommendation every few weeks. I mean, I'll never forget, a few years ago I was writing an investment newsletter for another firm. I did all the work, all the research, analysis, and writing for that newsletter, but I didn't own the newsletter, and a person in sales and marketing and promoting the newsletter, had told me that the owner of the newsletter wanted me to begin making new recommendations every few weeks, at least 3 new recommendations. I think 2 or 3 new recommendations every few weeks. And I'm like, oh my gosh, this is a recipe for disaster. There's no reason to do that. Why would you? This is not a short-term trading service. If we did have a short-term trading service, there's a good chance I would be making new recommendations every few weeks. A good chance, not necessarily. But as I wrote about in last month's monthly investment journal, we follow kind of the Ted Williams approach to the financial markets. Ted Williams, one of the greater hitters of all time in Major League Baseball, possibly the best hitter ever, if ranked on various types of criteria. We want to be very, very cautious and be out of the markets when our research indicates that economic conditions are going to worsen and the pace of economic growth around the globe is going to slow. We want to be pretty much out of the market. Why would we be in securities if that's going to happen? Once the economic environment looks like it's going to improve considerably, the pace of economic growth is going to increase, we want to start getting into equity securities. And when things look like they're getting better and better, we want to get fully invested. But there's no reason to have a new recommendation every few weeks. I mean, that's just nonsense. So for our growth and income portfolio, we want to be getting fully invested, but we don't want to chase stocks, and we're already 65% allocated to equities now. But we're not going to come out with some new recommendation every few weeks. I mean, I'm following closely and researching and analyzing companies and stocks that I expect to perform most other stocks during the year ahead. And so once I've made those recommendations, well, that's not going to change in a matter of a few weeks. I mean, we might hold these securities that I've already recommended. We might hold these securities for the next 12 to 18 months, or possibly even longer. And I'm just going to keep you updated on them. Next, for our income portfolio, well, once again, why would we have a new recommendation every few weeks? I mean, we're currently 75% invested in that portfolio, a 25% allocation to cash. And the only reason we're not fully invested is I'm waiting for some pullbacks in certain securities, fixed income securities that I've been monitoring. or I'm looking to add to our current positions at what seem to be good risk-reward price levels. But, there's just no need to try to come up with some new recommendation every few weeks. I mean, in my opinion, I have you, our subscribers and our clients, and what I think, my research indicates, are some of the much better risk-reward securities for fixed income portfolios, meaning securities that have little price risk, little risk of falling in price, or if they're going to fall in price, that it looks like they're going to fall only modestly, and very, very little default risk. We don't want to be in securities with a lot of default risk just to get a big return. But at the same time, even though these securities do have little price risk and almost no default risk, they're paying high yields. Except for the Vanguard REIT ETF, all of these securities that I've recommended for our fixed income portfolio pay an annualized yield of between 5 and 7%. Those are pretty good annualized yields for fixed income securities that have little price or default risk. And then, so I'm not going to be recommending a bunch of new securities for our fixed income portfolio. I mean, I have probably the ones that I think you should be in. I might, if I come across another 2 or 3, then I'll recommend those. Otherwise, I'm just going to tell you to add to what we're already recommending for that portfolio. And then for our speculative portfolio, it's a little different story. I mean, I'm monitoring numerous, I should say, actually about 25 small cap growth stocks of small cap growth companies that I would like to recommend, but they're either they're not yet making a profit, and I don't like buying stocks that aren't making a profit, or their stocks seem to still be overvalued by financial market participants. So we don't want to get into these stocks at overvalued levels. So there's probably going to be some more securities I'll recommend for that portfolio, and there's probably going to be more higher turnover in that portfolio, because if my recommendations perform in the way that I expect them to be, some of these are probably going to run up sharply. So then we'll take profits and we'll wait for a pullback and go back into them, or we'll go into other securities that haven't moved. Having said that, I am monitoring closely for our growth and income portfolio, as well as our speculative portfolio, Caterpillar, and so I might put out a trade alert on that any day now. See how it's trading at the moment. I might even put out a trade alert this evening. I don't know. I might. I got to look at it more carefully. And I'm also monitoring closely the Guggenheim Shipping ETF, symbols SCA, which was beaten down substantially over the past couple of years, my recollection. Yes, I mean, at one time, it was, wow. Go back to 2011, it was trading at around, let me take a look here, towards the end of 2010, I should say, it was trading at around $29 a share. It totally fell apart to around $11.50 during late 2011. Moved back up to around $23 during mid-2014. But then from June 2014 until around January of this year, it fell to a little over $11. That is, it fell from around $23.50 to around $11.50, or I should say just slightly under $11 in January of this year. And then it's been trading sideways since then. But I'm not quite ready to go into this yet. But it does appear to be stabilizing, so I might be recommending it any day now for both our speculative portfolio and our growth and income portfolio. Well, this video has turned out to be longer than what I expected. I thought it was going to be 10 minutes, and here I'm talking and talking. It's probably been 20 or 25 minutes already. So let's wrap this up. I have a lot of work to do for our the next edition of our monthly investment journal, and that's what I really need to get back to doing. I thank you for listening. Once again, I wish you a very, very happy holiday season, happy times with your families, and for those of you that are Christian, a very, very, very Merry Christmas. Thank you, and I'll speak with you again probably not this coming Saturday, but next Saturday. Take care. Goodbye.